a continuar hablando de investment. Now we're going to explore the impact of international VC funds on Barcelona's technological ecosystem. Marcel Rafart from Galdana Ventures is going to moderate this panel, and the speakers that he's going to be with are Lina Chong from Target Global and Jacky Abitbol from Cathay Ventures. Please. No le di.
So, hi, Ben.
How's it going, Ben?
Very well, thanks. Hi, this one.
I think that the intro was made for most of us, but not for Ben, because Ben was arriving
Late. No, that's fine.
late. Thanks everybody for your time. We'll try to make it as good as possible for the next 30 minutes of your life. We have a great selection of international VC managers. And since we only have 30 minutes, let me propose to ask you to make a personal intro for the whole audience. And then later on, I'll ask you to make an intro about your funds, the type of. So let's concentrate first of all on the personal aspect of your intro.
Great, I guess I'll start. Hi, everyone. I'm Lina. I'm originally from California, Korean American, started my career in San Francisco, moved to Europe about 14 years ago, founded a couple of my own businesses, and ended up in the investment side about 6 years ago.
Hi, everyone. My name is Jacky. Actually, I'm originally from Madrid. I grew up in Madrid and moved to Paris 15 years ago now, and I had a chance to come and spend 1 year here in Barcelona a couple of years ago. I've been with Cathay for 8 years, and before that I used to work also for a US company based out of San Francisco, Milpitas in the Silicon Valley. So I've been doing tech investments and corporate development for the past 20 years. Happy to be here today.
And hi, everyone. I'm Ben. I'm actually from Perpignan, so just across the border. Barcelona is basically my second home. Been an entrepreneur for almost 15 years, and a few years ago, with my co-founders, we decided to create the VC we would have loved to have when we were on the other side of the table. So that's how Breega got created, and we now have offices around Europe, invest from early stage to Series B these days. And I'm the recent father of two, so that's one of the reasons why I'm late. So happy to be here with you guys today.
Thank you. So let me ask you now to make a brief intro about your funds. So I think that the audience would be very interested in understanding the size of your funds, the investment strategy, type of companies you're looking for, and the average ticket size.
Great. So Target Global is a pan-European investment firm. We manage today about $3.5 billion. We have two core funds, so early stage and growth. Our early stage fund invests from pre-seed to Series A up to 5 million euros, and our growth fund invests up to 20 million euros. Two separately managed funds, very different. Our fund mandate is quite broad. We are generalist investors. However, internally, we have teams who focus on software and consumer and certain verticals, such as digital health, cyber, et cetera. We look for generational companies. I believe venture is a long game. So we have quite long outlooks for each one of the companies we look for. We want to have businesses that can compete on a global scale and tackle large, near universal problem spaces.
Take this one, Ben. So then we don't go the whole way all the time.
You took me by surprise. I was like, I still have 2 minutes to rest. Look, it's going to sound very similar. I think, we do, although we probably go a bit earlier stage than you guys. We usually sign checks from the very early days to, a couple of people in a garage and a few hundreds, all the way up to Series B. As I said, I think, it comes out of two different funds. We have one early stage, pre-seed, seed kind of strategy, and then a sort of later stage fund for the ones we would have missed early stage. That happens sometimes, so we have to wait and do the next round. We currently manage close to 700 million. As I said, we have people on the ground in London, Paris, Barcelona. in Europe. And we're 40 people, with a big chunk of them being in our scaling team. I think, one of our idea when we launched Breega was, to put only founders in the investment team, which is still true as of today. So out of the sort of 15-ish people who invest, they're all ex-entrepreneurs, and then build a strong scaling team to help our companies grow. And it's now a team of 10, so just dedicated to our portfolio companies. And here in Spain or even Barcelona, we're proud investors in Ukio and O11H and Dawa and a bunch of others. Coverflex down in Portugal, if we include Lisbon into Iberia. So yeah, we spend quite a lot of time here on the ground.
Mm-hmm. So as for Cathay, so we started 17 years ago. It started as a private equity firm, and when I launched and co-founded Cathay Innovation, it's the VC arm, so two separate activities. So we manage today around 6 billion euros, and we are, since day one, we've been like a global platform, a global investors with focus in three main regions, US, Europe, and Asia. Strong team and activity in China, but we recently opened, just before the COVID, we opened in Singapore to cover Southeast Asia. And on the innovation side, in Europe, so I'm in charge of European activities, so we started in France, and with Fund 1, so we did a couple of investments in Spain, so we were, I think, lucky investors in a company called Glovo, that you probably are all familiar with. And Fund 2, we invested in another Spanish company, also based out of Barcelona, called Wallbox, also a very good investment. Overall, in Spain, we've made something like 10 investments. So Europe for us is really mainly France, Germany, where we have an office as well in Berlin, and Spain, where we're going to be opening an office in January. Still, we are keeping the suspense, between Madrid and Barcelona. We may open actually in both cities. And now we recently launched our Fund 3, which is a 1 billion euros fund, which we started to deploy this year. We've made already 5 investments. We'll be closing the 6th one this year, this month, before the end of the year. And with this fund, the ticket ranges between 5, 10 as a minimum ticket, up to 30 million. I would say mainly B and C rounds, but we can come a little bit earlier. Maybe the last point interesting to mention is, as part of our investors, we have large corporate groups, and we create value for the companies by bridging and making sure that there are commercial relationships between our investment companies and those groups. And we invest in 4 main verticals. So we started with very agnostic, Fund 1, but slowly we've moved into more being vertical focused, and we invest in digital health, fintech, mobility, smart energy, and consumer retail.
I'm sure the audience is very interested in understanding how your life is today compared to what it was 2 or 3 years ago. The environment is radically different. With inflation and interest rates, I'm sure the investment strategy in your respective funds has changed. Could you share with us what are the main differences to what you are seeing these days, or what you're selecting these days, versus what you did in 2020, 2021?
I thought you were talking about pre-twins or post-twins, and I was like, well, it is a different life. Look, does it change anything? It does in a way. I think I think when you're an early stage fund, so it depends on what stage you're investing, right? But if you're early stage fund, a few years ago, you didn't have to think too much about if your companies are going to be able to raise the next round. Like, it was fairly normal, and there was a lot of money available. I think, these days it's obviously a bit of a different challenge, and people have to think about it a bit differently, I suppose. Later stage, same story. I think, the rationale of VC is that, at some point you're happy to pay a premium for something that you think is going to grow big, right? Because, we all know that when we invest, in a company, if we were to sell it the next day, it's probably not the same valuation, right? So we kind of find that potential equilibrium between what the founders want to take as a dilution, what makes sense from a valuation perspective, what makes sense going forward as a premium for us. And so that premium has been moving very fast to the sort of top, right corner corner of the, top right corner of the table, where people were paying, Series C prices for Series A companies. So yeah, okay, you can pay a certain premium, but at some point, the market sort of catches you, and you're like, probably that was probably a bit overpaid, and we didn't get to the valuation we were thinking of. Recently, we saw stuff that were probably exaggerated the other way around, where people didn't want to pay any premium, and they were like, well, I'm going to give you market multiple at Series B level, and you're like, well, okay, but it's not like it's gone cheaper to build companies. I mean, with inflation and competition on talent and everything, it still costs money. So you can't reach 10 million revenue with 3 million funding. Like, it's almost impossible. So that sort of irrationality, I think we need to, it's the human nature, right? People go far right or far left, and we need to go back in the middle a little bit. But it's really tough. I think it's tough for people who are, have been caught in that sort of momentum of raising a too high a valuation and not realizing the potential people were paying through premiums in valuation. And now caught into these two fires where either they raise money at a down round, which doesn't really look good, or exit without an amazing return, or cut and slash into cost, which you have to do sometimes, but to a certain extent where it sort of prevents you from growing to the level you were expecting. So all in all, it is a tricky situation, and I think our job has changed, not drastically on the investment side of things. On the fundraising side of things, drastically, because it was hard to raise money. It's even harder to raise money these days as VCs, and it's never easy, but it's even harder now. So it's kind of a business as usual, but with the handbrake on and a bit more, and your glasses on, and making sure you're not bumping into anything dangerous. Mm-hmm. To me, at least.
Okay. I would say what has changed for us is really the time to raise. I mean, for an entrepreneur, but also for a fund. Okay. So before, there's still money out there, but actually everybody is much more cautious when it comes to invest, whether it's again funds and entrepreneurs. Of course, there is a lot about the correction of the valuation. I still believe that in certain areas, lately we're talking about AI all over the places, and I don't know if it's an AI hype or not, but there's definitely no changes before with what it was in 20 and 2021. And I think the real change for an entrepreneur is that you need to have a model, especially in the stage where we invest, where we hear a lot about path to profitability, but I think you will not depend too much about the next funding round. Okay, and that is completely something, because it's not like, okay, you know what, we're going to launch something, and a year from now we're going to do another round, and we're going to open another 3 countries, and then we keep doing that. This is not happening anymore, and that is something that in terms of for the entrepreneurs, so to realize that this is very important. So you need to demonstrate that it works, your business model works, and then maybe you can think about doing the next round. And I haven't seen really that shift in 2022, okay? Maybe it's happening a little bit more now. And also, we're going back to what was before the COVID, where an A round was typically, 10, 12 or 8, 12. A B was 20, 25, etc. And what we saw is like this huge round, about 75, 100 million, 150, which didn't make any sense at all, because we were just, to make the math work, it was like super high valuation. And then when you look about exits, okay, potential scenarios, you say, okay, but who's going to buy that company? Especially when we look into the European market. Everybody talks about IPO. There's no market here for IPOs. So maybe I will not touch about this now. Okay, but longer processes, still money available. However, investors are very cautious. Okay, when it comes to invest, but they do invest. Okay, we get the money to invest. We're not getting fees. Just you need to live out of it. But actually what we are seeing as well is that investment period, whereas before it was like 3 to 4 years, now it has extended to more 5 to 6 years. And that also is, I think, a clear indication about longer I would say, investment cycles.
Yeah, I think when I think about, so we were investing out of our Fund 2 vintage in 2022, kind of like the real run-up to the bull market. And last year, we started to invest out of our Fund 3. And the biggest difference I think I see between the two funds is probably the maturity of the businesses that we're entering. So our fund is mandated not to go above a certain kind of valuation mark. So we kind of had guardrails in that sense. When the market was going crazy and paying up like 100 million valuations for pre-seed and seed deals, we just couldn't play there. So we had to kind of go downstream, and we're almost forced to go way more pre-seed than anything else, right? And out of Fund 2, I think we're really seeing kind of longer maturity times and yeah, a lot more conviction kind of based investments. What I'm seeing in the last year is actually it's been a great time to invest. So we have been deploying pretty steadily over the last 12, 18 months. We do find amazing businesses, sometimes seed rounds with 1 million, almost 1 million, let's say in bookings, not realized ARR, businesses like that are going out into the market raising at like 8 to 10 million pre-money, right? Which is like, I mean, that's fantastic. So I think that's kind of like the biggest difference. I think in terms of thematics or, you know, how we've changed any other investment strategy, it hasn't really changed. There's, of course, you know, you mentioned AI and things like that. There's, of course, these really exciting kind of themes where, you know, every investor, every founder kind of gets really excited. But we also saw that probably in every like generation of, you know, vintage, right? Before this one, before it was crypto, and before that it was something else like cloud or big data or whatever. And so from like a thematic or let's say research perspective, our jobs haven't changed that much, right? Our main job is really to discern like, does this new technology really help solve a problem, or is this just a software company that's all, you know, is it like a software wrapper around like a very fancy word or a very fancy technology? So yeah, from that aspect, not so much. But definitely, I must say the last 1.5 years has been like a fantastic time to deploy.
Maybe if I can add a comment on that, I think one space that we see, which I think takes us back to the roots of VC, is kind of the amazing opportunity around climate, you know, change. I think, you know, we've only scratched the surface of people doing, you know, marketplaces for carbon accounting or all the sort of, you know, very digital sort of high layer stuff. But we know that if we want to change the world we live in, we need to change the way we produce and consume food, and we travel and we build and we do all of this kind of stuff, which is not going to be only software, right? It has to be proper hard, you know, hardcore tech, and this requires capital. And so I think it sort of takes us back to the years where pre-cloud, before launching any tech businesses, you had to buy servers and probably invest to see if it worked. And I think that's an interesting point in time as well. And I'm eager to see how, you know, how much money can flow into these businesses with people taking proper risk again on early stage deals.
Mm-hmm. Can we speak for a few minutes about valuations? My assumption is that you guys are enjoying a good moment when it comes to new investments, because valuations have been compressed and corrected. And probably you have much more stress when it comes to valuing your portfolio companies, because you have all type of portfolio companies. Some of them do very good, some of them do very bad. So tell me about your view on valuations on both aspects, new investments and also valuing your current portfolio.
Okay, when it comes to new investments, I think that there is a perception of correction. I mean, there is a reality that valuation are more attractive for investors, and I think that also it's becoming something that the entrepreneurs are understanding, because basically at the end you still want to fundraise for the next round. And what happened in 2020 and 2021 is that it didn't really matter, because whatever valuation you will get, I mean, first of all, you were always betting or trying to get the highest or bidding to get the highest valuation as an entrepreneur, because you knew that for the next round you will get the money. Okay, and I have a good example. I will not mention the name of the company, but basically I mean, I'll go back to that example, okay? I'm not sure I want to share all of it. But anyways, so there is some kind of understanding that you don't take the highest valuation now. Before, it was really, you know, fine, you have the big names, you build a relationship, but then you're still very sensitive as an entrepreneur to say, you know what, I raised at 100. The next one was at 400. The next one was at maybe a unicorn, etc. And there was kind of a race to get to the unicorn level. And now it's more, okay, I want to make sure that, okay, there is a balance between the dilution, but also the reality, so that it will not put at risk the next funding round. When I was talking about AI, so it's not only about the hype, the excitement, it's the reality. But the reality is that we are, I think, I would say even higher than the 2020 and the 2021 evaluation when it comes to that, because the market is going there. It's really disrupting and addressing all kinds of industries. And it's more about the team. And then, I mean, we saw it, I think, yesterday, this French company, you know, Mistral just announced a 350 million round. Because basically, they have nothing. I mean, it's just a huge team. And again, I'm not saying that they have nothing. I'm just saying it's a team. It's not a product. It's not so it's still under development. So this is what we are seeing today as a reality. So going back to your second question, which is how our funds are valued. I mean, there is, I think it's very common among funds, which is, I mean, you take the valuation of the last round, okay? If it happens within 12 months, okay, you keep that, okay? And then you change it if the company is not doing actually its business plan or is missing its business plan by far. What's happening is that now a lot of these companies have not been able to raise not been able or not need, or just because there was not appetite, I mean, many reasons, or because they were reluctant to do a down round, okay? So basically you have a portfolio, or you have several companies that haven't raised for, 18 months, maybe 24 years. So how do you value that, okay? And if you take the last valuation, which was done in 2020 or 2021, so reality is that maybe if you go to the market right now, you will not get the same valuation. So this is, so we're spending a lot of time in, you know, assessing what is the right valuation, okay? First of all, as I said, it's about how the company is performing. It's about the comparables, whether it's public, whether it's private. And sometimes you need to adjust the valuation, okay? And this is something that your investors are also understanding. I mean, first of all, because most of them are also exposed to a lot of funds. So, and when it comes to the, TVPI and, book value, etc. So I think that now LPs are much more sensitive to the DPI than to the book value. Okay, so the exercise is being done, I think, on a general level. Okay, but at the end is, it doesn't mean anything that your portfolio is worth, I don't know, 5x. Okay, when you haven't made any exit. So it's this, I would say, 2-3 elements that are guiding, at least on our side, how we price or how we value our current or existing portfolio.
Yeah, I think probably from early stage, we've definitely approached valuations with a lot more discernment, right? So before it was like competition, winning the deal, pretty much at any price that we could take. These days, I think we try and look more fundamentally into the business, even if it's kind of back of the napkin stuff, right? At pre-seed or even A, sometimes really hard to know how revenue in the business develops. But we do tend to now look for a little bit more signals around things like, contract expansion, or net revenue retention, right? Revenue growth, the quality of that revenue, things like that. And then we try and get to a good ownership percentage, right? And to be honest, from early stage, it's really about ownership. So that's kind of how we would set the valuation. And from that perspective, it's actually gotten a lot more favorable for us. From growth, we are way more discerning. So there, I would say, either we're playing pretty aggressively on valuation levels. So maybe just to throw some statistics out there, now this is a little bit outdated, but first half of last year, average, let's say Series A's were they were around $20 million, right? Second half of last year, more than 40% of Series A's were like 5 to 10 million. So if you just kind of extrapolate what that means for valuation, right? And we've kind of seen that trend go into the last 3 quarters of this year as well. So from a growth perspective, when we're looking at very overvalued deals from like a year ago, right? What we're now actually, how we're approaching those companies is sometimes we'll negotiate like flat rounds, things like that. But we're also looking at more structured investments, right? So we want to have some downside protection. We're looking at some maybe higher multiples on liq pref, right? So these are the kinds of approaches that we're seeing from at least early and growth stage. There's going to be that odd deal here and there that's, you know, it's kind of like got everything right. It's in a hot space, right? Whatever that might be. It's amazing founding team. It's got a bit of traction and some numbers to show for it. And it's got a competitive round dynamic, in which case I think we still see a few of these deals kind of get, in my view, a little bit exuberant on pricing.
Mm-hmm.
Well, I don't have much to add. I think it's, valuation is an art, not a science. We come to the table, we're trying to find terms that work for everyone, and sometimes they do, sometimes they don't. Yeah, I think what, is doing some service to people today on the new deals is deserving them on existing deals, because a lot of people probably overpaid in the past. So all in all, as I said, I think, we should go back to something more normal. We know as investors that we need to pay a premium on early stage companies. So being too harsh on founders doesn't solve the problem ultimately. We need to make sure we find the right in between.
We are running out of time. I still have one pending question. So I'll ask you to be very, very efficient on your answer. Do you think the exit environment in 24, both M&A and IPO, will improve versus 23 and 22?
Ojalá.
Ojalá.
I hope so, but I'm skeptical.
Mm-hmm.
I think it will take some time, so maybe the second half of the year. I mean, we all hope that it's going to be in 2024. We had early signals, especially on the public market in the US in September. So might be, I think we need a bit more. I know there's a backlog of companies, just waiting, to get listed on the NASDAQ. So I think that.
And those that do just haven't really been performing.
Yes, exactly.
Outside of a handful so far this year.
Yeah, 1 out of 3, I would say.
Yeah.
But I think it will take a bit more time. Everybody's, I would say eager that it will happen in the short term, but I think it will take a bit more. Yeah.
Thank you. I think we don't have more time to any more questions, but let me tell you on behalf of the whole local community to thank you. Because it is great that funds like you guys want to come down to Barcelona, Madrid, and evaluate potential investments. My view is that human talent is more dispersed all over the world than the concentration of capital that we find in certain hubs. The smart investors 15, 20 years ago didn't want to travel because they were highly convinced that they had to do investments in Silicon Valley only. I think the smart investors are the ones who have realized that great opportunities will take place in many different places. And I think that Barcelona, in that sense, need international funds like you willing to come down and evaluate potential investments to complement the local capital that will obviously be investing into those companies. So thank you very much for this great session, and thank you very much for coming down to Barcelona to evaluate potential investments.
Thank you so much.
Thank you.
Thank you.
Thank you.
Thank you, Ben. Thank you, Lina, Jacky, and Marcel for your insights on international VC funds in Barcelona. Sesión, muchísimas gracias. Vamos